Welcome, everyone. Today, we're diving into a fascinating and frankly kind of terrifying explainer based on an exclusive anonymous expert report. We're going to be decoding the highly opaque behind-the-scenes mechanisms that lead to sudden bank account closures for non-resident business owners. If you are operating a U.S. business from overseas right now, understanding these hidden algorithmic triggers isn't just helpful, it's absolutely essential for your survival. Let's get into it. Here is our roadmap for today's explainer. We'll be hitting 5 key areas. First, the account closure mechanism. Second, high-risk operational triggers. Third, strategic transaction management. Fourth, the account warming phase. And finally, account setup and redundancy. All right, let's jump right into part 1, the account closure mechanism, and specifically, the phenomenon of completely unexplained terminations. So picture this. You're running your business, everything seems fine, and suddenly your account is shut down. Why are non-resident accounts closed so abruptly and literally without any warning whatsoever? The expert analysis reveals a really jarring reality here. We tend to think banking is a relationship, but in this space, you will almost never receive a polite phone call asking for clarification on a weird transaction. You just wake up one morning to find your entire operation completely frozen. And here is the harsh analytical reality driving this. U.S. financial institutions are simply not legally required to provide you with a reason or even a heads up before terminating your account. It's entirely at their discretion. The standard operating procedure across the board is just a sudden final notice that they are ending the relationship. And worse, they usually enforce a strict, non-negotiable 3-week deadline for you to figure out how to extract your capital before the doors lock for good. Now, this is absolutely crucial to understand. Your account is not being closed by a human bank manager who sat down, reviewed your file, and made a judgment call. No, it's executed by an automated algorithm that is constantly evaluating what's called your risk profile. Think of this as a digital thermostat that constantly fluctuates based on your daily behaviors. Once your actions cause that profile temperature despite past a hard-coded threshold, boom, the system automatically triggers a permanent compliance lock. There is zero human intervention required to shut you down. That brings us to section 2, high-risk operational triggers. Let's expose the implicit assumptions baked right into these algorithms. You have to understand that there is a stark black and white contrast in how these algorithms treat the flow of your capital. Incoming funds. The system generally views that as totally safe, standard revenue, low scrutiny. But outgoing international wires? That is an entirely different story. Those are treated with intense, automated suspicion. The implicit assumption hardwired deeply into these banking systems is that fast, outgoing international money is a massive red flag for either capital flight or money laundering. It's essentially guilty until proven innocent by the algorithm. So what specifically sets off the alarms? The data isolates 3 really catastrophic operational triggers. First, sending direct bank-to-bank wires to overseas high-risk jurisdictions. Doing this almost instantly guarantees an algorithmic freeze. Second, if you try distributing your international supplier payments across multiple different accounts. To a human, that might just be accounting. To an algorithm, it simulates structuring, which is a classic tactic used by money launderers to evade detection. That triggers massive compliance red flags. And third, any sudden, unnotified spike in your transaction volume will trip the automated wire every single time. Let's move on to section 3, strategic transaction management. Knowing what we know now, what are the required operational protocols? To survive in this environment, you absolutely must implement a strict operational mandate. First things first, cease direct bank-to-bank international wires immediately. Just stop doing them. Instead, you need to buffer your primary bank account by routing all of your overseas outgoing funds through licensed third-party intermediary payment processors. The golden rule here is to never, ever use your core U.S. banking infrastructure to wire money directly to an international supplier. It's just too risky. What you actually need to do is strategically silo your risk. It's a 2-step process. Step 1, designate one single account as an isolated burner account, strictly used for international payments via those intermediaries we just talked about. Step 2, route all your core capital and domestic operations through completely separate accounts. By doing this, you ensure that if your international payment node gets flagged by the algorithm and shut down, it doesn't take down the ship. Your broader core business infrastructure remains totally intact and operational. Now, physical cash withdrawals present a slightly different variable for the algorithm. They are generally acceptable, but they require strict preemptive protocols on your end. The core objective here is simple: avoid automated surprise. If your business requires a sudden, massive cash pull, you must proactively notify the institution first. Why? Because doing so inserts a human notation directly into your file. And that human notation is a critical step that can actually preempt and override a knee-jerk automated freeze. All right, section 4, the account warming phase. This is all about normalizing the algorithm to your specific business. When you start fresh, you must execute a strict account warming protocol. You cannot just open a US business account as a non-resident and push $100,000 through it on day one. It doesn't work like that. You are systematically training the bank's automated defenses to recognize what your unique transaction baseline looks like. So week 1 should be strictly restricted to small, routine deposits. Month 1 introduces a gradual, deliberate increase in volume. By month 3, if you've done it right, the algorithm finally establishes and normalizes your standard operational levels. The expert data is super clear, unequivocal really, on this specific point. Do not abruptly spike your transaction volume. The automated system completely lacks context. It doesn't know that your marketing campaign just went viral, or you just landed a huge client. All it detects is a massive, unprecedented deviation from your established baseline. And because its entire job is to mitigate institutional risk, it will just shut you down to be safe. Account warming is your best defense against this. Let's head into our final section, part 5, account setup and redundancy. We need to look at your overall structural architecture. Analyzing the primary methodologies for account setup exposes some pretty severe geographic and security risks. Let's break them down. Method 1, in-person branch visits. These are highly unpredictable. Honestly, it's often totally luck-based depending on the banker you get. Method 2, online neobanks. These offer great remote access, but they will automatically block specific residencies and citizenships at the door. Method 3, utilizing a third-party proxy manager. This boasts a high initial success rate for getting the account open, but it creates a massive, lingering vulnerability for you, the actual business owner. And look, regardless of the setup methodology you choose, your documentation simply must be flawless. Missing even one basic corporate document, whether it's your certified formation papers, a standard federal employer identification number, or verified proof of your home country address, results in an immediate automated algorithmic rejection. A human analyst won't even see your application. The computer will just toss it out instantly. Because these terminations happen instantly and without human warning, building structural redundancy into your business is absolutely mandatory. Never rely on a single financial institution. You've got to spread your operations across different bank types: online neobanks, traditional commercial banks, and regional credit unions to create a truly resilient safety net. In fact, credit unions are specifically highlighted in the expert data because they still allow for real relationship building with human bankers. And as we've learned, having a human in the loop is a rare and critical advantage when you're trying to circumvent automated systems. Now, if you are forced to use that third-party proxy to establish the account, you must execute immediate emergency protocols to eliminate your security risk. You absolutely cannot leave a proxy with legal signatory access to your capital. The data dictates a strict timeline. As soon as the entity is viable, you must travel to the jurisdiction, physically walk into the branch, remove the proxy manager from the paperwork, and legally establish yourself as the sole owner. So I'll leave you with this final provocative thought. Knowing everything we just covered about these hidden algorithmic triggers, is your current financial architecture resilient enough to survive a sudden compliance freeze today? Remember, the algorithm does not care about your business model. It only cares about risk. Audit your risk profile right now, build out your structural redundancy, and secure your operations before an automated system makes the final decision for you. Thanks for joining me on this explainer, and definitely put these actionable insights to work to protect your capital. See you next time.